The thing about the trade desk is that they're imagining a whole new world for the future of digital advertising, and they're actually making it happen. While Google is tied up in lawsuits for competing on both sides of programmatic ad exchanges, the trade desk is filling that void, soaking up new business and becoming a trusted DSP for ad buyers.
I mean, when you compound sales at 50% per year for over a decade, you must be doing something right.
And the thing is, we are still in the early stages of what advertising across the internet can be. For goodness sakes, more ad dollars are going to be spent on cable TV than streaming this year, and that just will not last forever. Many of those cable dollars will flow to digital advertising and into the pockets of companies like the Trade Desk.
Today, we discuss whether the future of digital advertising will be on so-called walled gardens like Amazon and Facebook, where individual big tech companies control the entire digital advertising ecosystem from top to bottom, or whether the industry growth will come primarily from the so-called open internet, where decentralized networks of publishers can tie their inventory into ad exchanges that advertisers competitively bid on. That is more or less the heart of today's conversation. The Trade Desk, ticker TTD, is the company you are here to pitch, Shawn, and they're very much on the open internet side of this equation, acting as a neutral broker to facilitate the bidding process and corresponding data analysis behind the campaigns of marketing agencies worldwide. And that includes everything from demographic targeting to precise insights on the cost per impression and performance of an ad placement. Trade Desk's mission, as I understand it, is to empower ad buyers that want to purchase ad spots on the open internet outside of the purview of walled gardens like Amazon and Facebook. Is that anywhere close to a good framing for today's episode, Shawn?
I think that's pretty good, Daniel. Nice job. I'm excited to dig into this one. You captured it well, and ad tech can be complicated, as we were talking about before the call a little bit, but we'll try to make everything as simple as possible to understand. And I'll paint the picture for why the Trade Desk may be one of the biggest beneficiaries of growth in the digital advertising industry more broadly, and how specifically they might benefit from some of the antitrust rulings against Google's influence over digital advertising.
It all makes for a great story. Almost another David and Goliath story, like the one we covered with Nubank a while back. And if you can call a $35 billion company like Trade Desk a David, but they're certainly going up against Google and trying to pull business from them, which we should be interested in generally, whether we end up investing in TTD or not, since Alphabet is one of our largest portfolio holdings. But we're getting too far ahead of ourselves. So how about you give us an overview of what Trade Desk actually is all about?
Well, anyone who has owned the Trade Desk for a while has done really well, plain and simple. Since IPOing in 2016, the Trade Desk has compounded its stock at more than 40% a year, even after hitting some turbulence earlier this year. And the way I like to explain what they do in the simplest possible terms is that they are a technology platform helping ad buyers figure out the best place in time to show an ad on the internet, and also helping to automatically purchase that ad space for them. So they are fundamentally a programmatic advertising network, meaning they enable automatic purchases of digital advertising real estate and help buyers of that ad space be more sophisticated about the ways in which they bid on advertising inventory. And unlike the ad giants like Google and Amazon and Meta, which, as you kind of refer to, are often called walled gardens, Trade Desk exclusively serves advertisers, and that helps them avoid conflicts of interest by not also representing their own ad inventory. They are a truly neutral broker, unlike their competitors, which long-term I think can be an advantage for them. And for example, when you go to buy ads on YouTube, you have to go through Alphabet's own broker. And so you can see how there are some conflicts of interest there. The Trade Desk, on the other hand, doesn't care what ads you buy, but rather it's motivated to help you get the best price and value on those ads, irrespective of where that ad inventory is being hosted. And that's just a big difference in perspective.
And in being this neutral intermediary for ad buyers, how do they actually generate revenue? Are we talking about fixed fees, variable fees? How exactly does that work?
So the primary way the trade desk makes money is by charging its clients a platform fee, typically calculated as a percentage of the total advertising spend, which you might often refer to as the gross spend that flows through its platform. And this take rate is generally about 20%, meaning that for every $100 in gross ad spend, TTD would typically recognize about $20 in revenue. So this may seem like a really large cut for them to take, but the value proposition is that TTD helps advertisers drive meaningfully better outcomes with more efficient customer acquisition, for example, than they could achieve through traditional or less optimized digital ad channels. So even after paying TTD's fee, advertisers probably still see better ROI, effectively making the platform's cost worthwhile. And that said, once all the middlemen in the programmatic advertising supply chain take their cuts, the publisher, which is the party showing the ad, may only end up with 50 to 60 cents on the dollar from that original ad spend.
It sounds like one of those businesses that we personally love and also have some others in our portfolio where they're just asset light and with high gross margins. From what I'm seeing here, it's in the range of 75 to 80%. And that's basically since it doesn't own advertising inventory or any physical infrastructure for that matter. And it's basically just an agent and platform facilitating ad purchases. But the most impressive stat from what I've read is their customer loyalty. Their retention rates are something like 95%. So it seems like a very sticky service that they offer. And that's despite taking what seems to be a very high take rate.
And like I said, they focus exclusively on the buy side, as in advertisers and the marketing agencies that those advertisers hire for them. So the trade desk does not own or sell its own ad inventory in the way that a company like Roku does, for example, which is a company we covered recently that sells ad space on its home screen that appears on tens of millions of TVs across the US. They also don't represent any publishers, which is the sell side of the digital advertising ecosystem. Netflix is a publisher of video streaming content, so they're very much on the sell side, and therefore the trade desk wouldn't directly represent them unless Netflix was taking on the role of digital advertiser to promote their subscriptions. And the business is kind of like automated trading in financial markets in a way. And with automated trading, a trader creates these complex algorithms to systematically estimate a fair value for a set of investments. And the trader then programmatically buys and sells the investments based on any deviations between that fair value and the market value. And somewhat similarly, the trade desk empowers advertisers to adjust targeting factors like their ideal demographics and locations to algorithmically value advertising inventory as it becomes available and then bid on it.
So they align only with buyers. And I would guess this then is a data heavy business, obviously, right?
Yeah. The whole platform is highly data driven, as you can imagine, and they enable clients to use various data sources, from a client's own proprietary data to third-party data available on their marketplace and data captured by the Trade Desk's own platform to optimize these advertising campaigns and target audiences more precisely. So that data could show what device you're using, your location, browser history, any kind of stuff like that. It's a very transparent platform, honestly. Clients can see their costs for advertising inventory, the platform fees, as well as detailed performance metrics. And that transparency allows clients to understand and optimize their ad spending at scale. And with that, Trade Desk platform allows clients to run integrated campaigns across many different channels and devices, from mobile apps to websites, and even across so-called connected TVs or smart TVs like Roku. Another fast-growing area here that I want to mention too is known as retail media. So they've partnered with Ulta's UB Media Network to enable ad campaigns starting Ulta's 40 million plus loyalty members and the company's treasure trove of data on those folks. And it's just a great illustration of how the Trade Desk is directly creating value for one of our core portfolio companies. And I think this retail media opportunity is huge and really exciting for them. From Ulta to Walmart and Target and all the retailers in between, these companies are trying to better monetize the relationships and data they have on their recurring customers. And one way these companies have been doing that is by partnering with the trade desk to unlock new advertising opportunities. And I'll just quickly read a note here from the CEO of the digital ad agency, Acadia. He says, retail media has been synonymous with Amazon, but 2024 will probably be the year that this link starts to fade. The investment chips, at least from our clients, are starting to flow into Walmart, Instacart, Kroger, Chewy, Ulta, and more. And now, my words here, the trade desk is at the center of those advertising flows to retailers beyond Amazon.
Maybe perhaps that helps if we just quickly explain Amazon's ad business once again. I mean, most people will be familiar with it, but the magic behind it works is really how Amazon uses its first party shopper data, like search behavior, like purchase history, and also product views, and all that to just sell targeted app capability to brands looking to reach high intent consumers at the right point of purchase. And Amazon has really everything they need to make an ad as effective as possible. Many other retailers have similar data, but perhaps not the tech infrastructure or not the demand aggregation to scale all that data. And a monetizable ad product just doesn't go without having all of that. And that's what Trade Desk is trying to do for all these other retailers. To get an even better understanding of this, maybe we should quickly talk about the broader digital ad market, just so that we're all on the same page. Like, who are the players? How does it all work? What are the different forms of advertising and anything else like that that you want to speak about?
Let's start with the basics of advertising on the internet. I think it really all began with website publishers trying to monetize the eyeballs that land on their websites back in the 90s. And now when you visit a website, as it loads, the publisher initiates a series of auctions for those ads that will be shown to you. And publishers, as in the publisher of the website you might be visiting, like, I don't know, maybe ours, theinvestorspodcast.com, go through supply side platforms, aka SSPs, that's what that stands for, to list advertising real estate. Whereas advertisers are going through demand side platforms, aka DSPs, so like the trade desk, to purchase those ad spots from publishers and then to essentially bid against each other for that available ad space. And when an auction for that ad is won on an ad exchange, it's then sent to the publisher and it shows up on your screen. And the really incredible thing is that all of that happens in a fraction of a second. Alphabet has famously been on all sides of this, controlling sell side platforms, demand side platforms, and the ad exchange. And the comparison I typically use, it would be like if you were buying a house and your broker also represented the seller of the house too. There's obviously a pretty clear conflict of interest that has made Alphabet billions of dollars, and as shareholders in Alphabet, we're very happy about that. But now this is attracting regulatory scrutiny, and it's probably not sustainable in the way that it was. And the trade desk, for what it's worth, as we keep emphasizing, but I think it's really important to understand, is only on one side of that equation, representing the buyers of advertising space. They made an intentional decision to pick one side, and they chose the side with what they believe are the better economics. Since there's this kind of imbalance of structurally, there's always going to be more advertising real estate, more people who want advertisers than there actually is demand for that space. And just to maybe show you how this all works, if a company like Ford wanted to run ads that pop up as banners on a website like CNN or CNBC, they would go through the trade desk to purchase those ad spots, while the publishers, which would be CNN or CNBC in this case, would work through a supply-side advertising platform like Programmatic, ticker PUBM. And this whole process amazingly occurs tens of billions of times a day across most of the major web pages on the internet, videos, music, TV streaming platforms, and everything in between, basically in the fraction of a second it takes for a website to load.
Wow. I mean, perhaps it's just me, but I never really paused to think about how all of this actually works. If someone had asked me whether on a website everybody sees the same banner ad, of course, I would have said no, it's obviously personalized, but I never really considered how that specific banner ends up on my screen. And then 10 seconds later, a different one shows up on the next site I visit. And what's even crazier is, as you mentioned, that all of this targeting, decision making, and the delivery happens in a fraction of a second, and that every single time.
And all of this is known as programmatic advertising, which is a specific type of advertising that is more automated. Advertising deals, I should say, are still directly negotiated all the time. But the best example, the difference I think is probably on YouTube. So the 5-second ad that plays when a video first loads is typically what we'd call a programmatic ad. Whereas the ad read that a host might do during a YouTube video as part of the actual content of the video, that is not programmatic. That is part of some ad deal that they would have directly negotiated with a sponsor. And on our show, none of the ads are programmatic because we read the ads ourselves. But other shows do use programmatic ads. And maybe you've noticed on certain podcasts when the ads aren't being read by a host and they can sort of be very abruptly inserted into the content. And just working in the industry, I can tell what these automated ads are, but maybe it's not as noticeable to everybody else.
Honestly, from a consumer perspective, these programmatic ads, for example, on YouTube, really have become one of the most annoying things on the platform. I have YouTube Premium for quite a while now, and I would never go back. And that's not an advertisement, by the way. But yeah, working for a podcast network now, I think it showed me how many nuances there are in the advertising business, from programmatic ads to self-negotiated ones. And the programmatic ads are just, they're a lot less work, of course, but you also get less money. And as I said, I find them to be the most annoying and often also just lower quality. And that's why, as you said, we don't do them on our show. You also have no say in who advertises then. And especially when we talk about a topic like finance, I think there's a lot of trust involved with the audience. And I just wouldn't want some scammy website to then buy ad space on our show because they were the highest bidder. I must say, though, that Jeff Green points out, and he says that repeatedly, that all of this free content on the internet wouldn't be there or wouldn't be available without those ads. So there has to be some form to monetize. And if it's ads, and so that's why you don't have to pay, it's probably the best way for the consumers.
And you can see how this system came to fruition, right? It's way more efficient for a marketing agency to tap into an advertising network that has aggregated thousands of websites to advertise across automatically than it is to try to directly reach out to individual publishers and manually negotiate sponsorships. And additionally, if you're a marketer, you want to make sure that if you run ads across 200 websites, you want to make sure you're only getting charged if those ads are actually shown and shown correctly. And rather than trying to verify and track all of that by yourself, by going through a buy-side platform, you have a third-party company like the Trade Desk managing things, but you also have these verification companies like Double Verify or Integral Ad Science that might be integrated into the Trade Desk platform, basically just helping you track and verify that, like I said, the ads are actually run, who saw them, how much it cost per impression, how they performed, and all that kind of analytic and reporting data that is just extremely important to marketers who are trying to track how their campaigns have done across different places.
This ecosystem sounds so refined now, but as we've learned from looking at Amazon, very few businesses were actually able to build it. So how did it come about for Trade Desk?
So the thing is, there were so many different ad networks that popped up trying to aggregate publisher content when the internet started to take off that they sort of had the same problem again as back in the days when advertisers would primarily reach out to publishers directly to negotiate deals, which was obviously a very manual process. And the problem was just on a different scale. Rather than debating about a specific publisher to work with, a marketing agency would have been debating what ad network to use to tap into a wider network of publishers through. So thousands of publishers were brought under the umbrella of a specific ad network, but there were soon dozens of ad networks to choose from. And that's how the concept of an advertising exchange came to fruition. And on these ad exchanges, a marketing agency could bid on ad spots across different ad networks interchangeably, kind of standardizing and commoditizing advertising real estate across the internet. And from a programmatic advertising perspective, as a marketer, you might now bid on advertising inventory across the open web as it's known, Or with certain arrangements, you might bid on inventory from these so-called walled gardens like Spotify or YouTube through an ad exchange that aggregates ad networks together. And it is a messy process. And I think we're probably going deeper than we need to. But I think it's helpful just to paint a picture of the nuances behind advertising technology and its origins to understand the pitch today. And the idea is really to streamline much of the content across the internet so marketers can uniformly bid on ad spots, quote unquote, programmatically. And this can happen with everything ranging from YouTube videos to banner ads and websites, music streaming platforms, and again, smart TV platforms like Roku.
And as always, these things are very dynamic though. And my understanding is that Trade Desk's role may actually be beginning to change. So maybe you can tell us a bit more about this project, which is called the Open Path Initiative, because I think we haven't discussed that yet, but it's probably important.
Open Path is interesting. It was developed to give clients access to advertising inventory through a direct connection with publishers. The idea is to address inefficiencies in the traditional advertising supply chain, which traditionally involves multiple intermediaries, such as ad exchanges, these demand-side platforms like the Trade Desk, and then the so-called supply-side platforms for publishers. And all of these intermediaries can, of course, create inefficiencies and costs for advertisers who are just simply trying to get the best return on their ad spend, and for publishers who are trying to maximize the value of their inventory. And so OpenPath allows the Trade Desk's programmatic buying algorithms to plug directly into publisher inventory, effectively eliminating some of the low-value, high-cost middlemen in the supply chain. And I think it's a pretty exciting development, but also a phase shift for the company, potentially. TTD is really broadening its scope and simplifying the advertising supply chain, but changing industry standards is not going to be a straightforward process by any means, because it requires publisher adoption to make this new network effect worthwhile that they're trying to build. But if it's successful, we're talking about dramatically expanding the Trade Desk margins by removing middlemen and allowing them to take a even bigger cut of revenues.
Well, then, how has that looked? Are they having success with scaling the adoption of OpenPath, or is this all just narrative stuff at this point? Because when I look at the stock chart, without having any, further knowledge on the company, it looks like there has been something going wrong, and perhaps it has been OpenPath.
It's so hard to find like-minded folks who speak the language of value investing. I know most of my friends and family are tired of hearing about my stock picks, so that's why we created the Intrinsic Value Community. It's a vetted private network for sophisticated long-term investors who care about deep research, sharing actionable investment ideas, and making meaningful connections. After a certain point, reading yet another value investing book only helps so much. Beyond actually getting my feet wet in picking investments, nothing has helped me more than getting feedback from a peer group of passionate investors who have supported my investing journey over time. From community debates about investment opportunities to calls with industry experts who share their unique strategies and insights with our members, it's a special group that I couldn't be more grateful to have been a part of. Spots in the community are limited though, and our latest cohort of 30 members filled up lightning fast, and our upcoming cohorts will probably be even smaller. If you want to take the next step as an investor, then go ahead and join the waitlist for our Intrinsic Value Community at theinvestorspodcast.com/intrinsic value community. That's theinvestorspodcast.com/intrinsic value community. What if every home had a freeze dryer? Sounds crazy? Maybe, but once you see what a Harvest Right freeze dryer can do, I think you'll be wondering how you ever lived without one. With a Harvest Right freeze dryer, you can preserve what you love to eat, from fruits and vegetables to full meals. You can keep your favorite healthy foods fresh for years. No more highly processed foods loaded with preservatives. As a value investor, what I love most about Harvest Right is that it helped me to stop throwing away leftovers or having to watch my fruits and vegetables spoil before I could eat them all. Freeze drying can be both healthy and fun, of course. You can make nutritious snacks like freeze-dried fruit or fun snacks like freeze-dried ice cream and candy that your whole family will love. My Labrador Retriever, Riley, certainly loves her freeze-dried treats. So go ahead and stock your pantry with real, wholesome food that's always ready when you need it, no matter what is going on in the world. Learn more by visiting harvestright.com/investors. That's harvestright.com/investors. Hey guys, this is your host of the Intrinsic Value Podcast, Shawn O'Malley. Just like everybody else, there was a time when I was a beginner investor, and I have to say, investing is particularly filled with jargon that can just make it so difficult for new investors to understand what is going on. But it's never too late to get smarter about stock investing from the ground up. At the Investors Podcast Network, we've made a habit of studying the world's best investors, and now I'm distilling those learnings into a simple course for you, or for anyone in your life who you might want to share the gift of knowledge with. With my How to Get Started with Stocks course, you can master the principles of excellent lifelong investing with valuable insights for both beginners and pros. The course covers 10 different sections, beginning with the basics of what a stock actually is and how the stock markets work, to strategies to optimize your retirement savings, how to pick great companies for the long term, what to look for in ETFs, and how to monitor your investments, plus so much more. To begin getting smarter about investing, just visit theinvestorspodcast.com/get started with stocks. That's theinvestorspodcast.com/get started with stocks. And for a limited time, you can use code STOCKS15 for a 15% discount at checkout. I don't think it's just a story or fluff from management. I do think there's been real adoption with OpenPath. A bunch of really big players are partnering with Trade Desk on it and have used it to support ads on Disney Plus, and Vizio has used it to power their advertising ecosystem behind the 24 million TV products they have in the US, while Fox has actually been deploying the OpenPath technology across their entire digital portfolio, and Warner Bros. Has done something similar, and same for The Guardian. And even Spotify is actually leveraging OpenPath. So I think they've gotten some real heavy hitters on board, which is really exciting. But of course, there are many, many more publishers who have not embraced it yet. But still, management has said 2025 will be the year of accelerating growth for OpenPath. So we'll get a better idea in the coming months how this is all coming together and how real it actually is.
It's definitely a time of big change in the digital advertising world. And it seems like Google's monopoly over website advertising is being broken up. And Alphabet, as we say so often, is one of our core portfolio companies. And so we've known that the Google Network segment, as it's called, is sort of in structural decline because of regulatory enforcements. And we've also talked about this already, but this unit generates north of $30 billion per year for Alphabet. And now it seems like much of those revenues are getting carved up by companies like the Trade Desk, who will be the primary beneficiaries of Alphabet's loss of power in digital advertising. And to be clear, we're not talking about the cloud, YouTube, or search businesses that make us excited about Alphabet. I think this is a specific aspect of the business that just acts as an advertising exchange for publishers and marketers that is in trouble.
The way I think about it is that the Trade Desk could actually partially hedge our Alphabet position in a way. Then if regulators break apart the Google ad network, by all accounts that I've heard, this should really level the playing field and drive a lot of business to the Trade Desk, and also potentially drive more adoption of OpenPath. And the other kind of structural tailwind supporting them is that content streaming platforms, so think Netflix and Disney Plus, have moved to ad-supported models to drive incremental growth. And that means they need to achieve much wider scales and will need to be spending a lot more on customer acquisition, because if you're moving from a paid premium subscription to more of an advertising business, scale becomes increasingly important. So it's a different play on the thesis we discussed with Roku, where streaming platforms are all pushing pretty aggressively to reach scale with their user bases. And then at the same time, you just have structurally more advertising dollars moving from cable to the internet every year. And to illustrate that, connected TV advertising, so that is the ads that are shown when streaming on a smart TV, is about half of the Trade Desk sales currently. So they are very closely tied to the same trends that underlined that Roku pitch we went to recently, and actually are, at least currently, a much more profitable and healthy business than Roku, which is why it caught my attention.
The numbers look fantastic. I mean, the results have been not only inspiring thus far, but it also seems that they can keep going like that. Revenue has compounded at 34% a year on average since 2016, and with 27% free cash flow margins, which is also, fantastic result. And according to a Morningstar report, the total addressable market for digital advertising is about $700 billion right now, but it will likely grow to $1.5 trillion by 2034. Right now, I think the trade desk accounts for something like 2% of the market share, and it seems like it has been capturing market share in the last years and may do so faster if the regulatory enforcements against Alphabet actually proceed as expected. And that's just a huge opportunity to grow even 10 years out.
So you've captured a chunk of my thesis perfectly, Daniel. My idea is that if the trade desk can expand its market share to touch something like 5% of digital advertising over the next decade, well, that would imply that they could continue to compound revenues at least 18% a year for the foreseeable future before running out of runway. And that is what gets me so excited about the company's potential. And the opportunity there is even bigger if OpenPass adoption continues to accelerate.
That's totally understandable. But before we get too ahead of ourselves, one of the more important terms we probably need to understand here at the core of what Trade Desk does and represents is this concept known as the open internet. And we've already talked about it, and perhaps it's clear to many, but just to make sure we don't lose anyone, can you just define for us what exactly that term describes?
The open internet refers to the parts of the internet that are accessible to advertisers through interoperable programmatic ad platforms, and which are not controlled end to end by a single company like Meta or Google. And when you scroll through things to watch on your Roku TV, that is sort of another way to access, again, what you would call the open internet. And meanwhile, Facebook and Instagram, on the other hand, are not the open internet. They are these walled gardens. They're self-contained ecosystems. And that is really not what we're talking about with the Trade Desk. The open internet is more about independent, decentralized publishers and content, news outlets, podcast companies like ourselves, streaming apps. Those can all make up the open internet in different ways, especially with respect to advertising. And in a walled garden like Facebook, Meta completely controls the sale of advertising inventory to prospective advertisers, whereas the open internet is maybe a bit more democratic. In the context of advertising, walled gardens refer to the platforms that are really in charge of what content users see, which companies can place ads, which user segments are served the ads, what users can do after seeing the ads in terms of clicking a link and being driven to a page from the advertiser, and how this goldmine of data is collected, shared, and then remonetized. And so alternatively, any place that can tie into cross-platform programmatic advertising really is what you would call part of the open internet. You might think Netflix, for example, is a walled garden, but actually it is more of the open internet since they enable programmatic ads. They used to be a walled garden that was closed off and didn't even have any advertising, but now they sell their advertising inventory through Microsoft, and then on the buy side, they work with the Trade Desk.
That's very interesting because what's kind of floating around in my head right now is the question of how much of the overall digital ad market is open and how much of it is a walled garden. And beyond that, whether there's a trend toward one of them growing faster than the other. I'm not sure if you have any data on that. So I did do some digging myself, and it turns out that my intuition is kind of right that walled gardens are actually the bigger part of the market. Depending on the reports you look at, they're supposed to control 60 to 80% of the digital ad spend. And that's interesting, but there are also signs that this is kind of reversing, especially due to regulation. And perhaps that's also where Netflix comes in, because, I mean, you would think that they have everything to do it internally, right? Most importantly, the data and also the technological know-how. So I guess my question is, why has Netflix sort of outsourced this and embraced a more open internet approach? Is it part of the trend that even for companies like Netflix, it makes more sense now to not go the walled garden approach?
It's a really, really interesting question. And the answer from what I know is that companies like Alphabet, Amazon, and Meta have just simply built up the infrastructure and scale to manage their walled gardens over many, many years. And these are immensely complex algorithms with very powerful servers behind them, requiring tons of data to be competitive if you're truly taking a walled garden approach. And so Netflix, despite how big it is, isn't quite on that level, and they don't have the diversity of advertising inventory that I think would make for a good ad exchange. So they just opted to more quickly monetize their user base by taking the programmatic approach and relying on the trade desk, as opposed to trying to build all of that advertising infrastructure themselves.
So there's not a huge idea behind it. It's more just a pragmatic move to save on costs.
I would probably say so. And I think it's an implicit acknowledgement that they just don't have the scale, like I said, in data that these other players have. Where, I mean, think about how much more information Google has on you than Netflix. Netflix doesn't need to fully open the floodgates. I think it can remain selectively open and offer some of its premium inventory to high-end advertisers through curated buy-side partners like TTD, which gives it the benefits of openness in terms of demand and the tools they can offer without totally giving up control of their platform and the data they have on customers.
Yeah, I think that makes total sense. I wasn't aware of just how complex these algorithms need to be. And at least until I heard of the 20% take rate that TTD takes, I figured there have to be some serious value add for companies to pay that. So now we've covered what Trade Desk does, their unique positioning in the industry, what the open internet means, and we also talked about open path. My understanding is that other big variable in this story is around something called UID2. So how about we double click on that?
Well, so it's going to get even more complicated and wonky here, but let's do it. UID2 is this new open source identity framework developed to operate on the open internet. And it bypasses the need for the legacy system called third-party cookies in many cases, which at this point, I think we've all probably heard of. Most people probably don't know what cookies are, other than that they're kind of tracking you. But they have very much made up the backbone for a lot of how digital advertising has worked in the 21st century. And now we're at this point where cookies are increasingly being phased out. And UID2 is Trade Desk's idea for what can replace cookies. And now that they've made UID2 open source and handed it over to an independent body, they have separated themselves enough that it could actually be adopted widely without this obvious conflict of interest. And the main goals are to preserve the value of relevant advertising opportunities while providing consumers with more transparency and control over their personal data, if that makes sense. So you might kind of think of it as an upgraded version of third-party cookies that are more privacy conscious, but still balance the needs of advertisers.
Shawn, in case you want to dig deeper into the technology here, I will take the fall. And I will say that I'm one of those people who don't really know what cookies do beyond tracking the details of my behavior on a site and kind of using that to build a profile on me for ad purposes. So perhaps you can dig a bit deeper on that.
Okay, let's get into the nitty-gritty then for a moment. The way UID2 works is by transforming encrypted email addresses or phone numbers provided by users into a pseudonymous advertising identifier, aka a UID2, that is designed not to directly identify the individual personally. And according to the company, they believe that UID2 has reached a critical mass of adoption and continues to gain strong momentum among publishers, data partners, and advertisers. And some of those notable adopters are ones we've discussed with OpenPath, like Disney, Warner Brothers, Spotify, Roku, and Fox, as well as DirecTV, SiriusXM, and iHeartMedia. And basically, if it's widely adopted, UID2 could reduce the cost and complexity of aggregating consumer behavior data. And basically, long story short, more effective advertisements at a lower cost for ad buyers. But of course, that is a big if. And if agencies and brands can better target audiences across the open internet due to UID2, especially on connected TV and streaming platforms where authenticated logins are common, that is going to be good for the Trade Desk business long term, even if they don't directly oversee UID2 anymore. And more precise targeting drives higher ROIs for advertisers, leading to more spending on TTD's platform, where it takes that 20% take rate we've discussed. And the way it kind of works in practice is that UID2 could link a streaming ad shown on a Roku TV to a website visit from someone who sees that ad and then pulls up the page on their phone. That is the kind of data and tracking we're talking about and why it matters to advertisers.
Okay, so another way to think about this is that platforms like Meta and Google have access to vast amounts of proprietary user data, but they tightly control how advertisers can use it. And in contrast, UID2 helps kind of level the playing field by enabling user level targeting and measurement across the open web, making it a viable alternative to these walled gardens, but at the same time reducing reliance on third-party cookies, which walled gardens don't use anyway. But that brings me to the next question for you, Shawn. What are the main competitors to UID2, and what could stand in the way of widespread adoption and indirectly strengthening the trade desk's position?
I think the team of the Trade Desk would very much agree with your assessment there, because it sort of paints him as being this Robin Hood-like figure, is sort of a noble hero protecting privacy and empowering advertisers across the open web. And that is a simplification, but directionally, I think that is maybe the right way to think about it. But in terms of UID2, Alphabet continues to be a competitor even here. They obviously have their tentacles around everything, but Alphabet has something called the Google Privacy Sandbox, which on the one hand is even more privacy focused to satisfy regulators, which makes sense. Google's gotten all this negative attention on them, so they're kind of overcorrecting. But then on the other hand, that comes at the cost of cross-site tracking and attribution, which makes these advertising tools less useful to probably most advertisers. And so this is primarily useful for tracking identities when searching a computer browser, whereas like we've talked about with UID2, you can actually track identity and engagement across a smart TV, and email, and phones. And so they almost serve totally different purposes to an extent. UID2 is good for premium news or TV streaming, where people tend to have to log into a service, and unconnected at TV at least. Cookies were never really used here anyways, but actually Google has, to make this all more complicated, kicked the can down the road a bit and recently did a U-turn on its decision to abandon cookies. So the whole future of their privacy sandbox is entirely being called into question now, after Google has made some promises like cookies would no longer be needed, and yet they don't seem to be able to fully move away from them.
To my knowledge, the entire sandbox project was actually stopped just about 2 months ago. I guess that kind of just shows how hard it is to balance privacy with effective targeting. And even the regulators didn't really like it. I mean, you would think they are a fan of more privacy, and I'm sure they are, but they didn't like the idea of Google once again being the dominant driver behind innovation in that space, and basically consolidate its dominance in the online advertising market instead of weakening it. But is Google even the most serious competitor in that segment, or are there other competitors as well? How does the landscape overall look like?
Yeah, I should say there is another product called Ramp ID from a company called LiveRamp, but it is more of a closed ecosystem than UID2, which is very much an open source project at this point. And there are probably 4 or 5 others I could name around the world that are popular in different areas or that are relevant within different niches and may ultimately be used in combination to complement each other. But given Alphabet's control of search browsers and search itself globally, they still very much shape everything that happens in digital advertising. And we'll have a lot of say over privacy and tracking protocols going forward. But as far as the open internet is concerned, UID2 is pretty well positioned, in my opinion, to redefine the status quo here. And the way to think of it is that UID2 is the Trade Desk's offensive weapon to make advertising across the open internet more competitive and maybe even superior to advertising in the walled gardens of any of these big tech giants. And if it doesn't gain wide adoption, ad dollars will stay trapped or maybe even shift back to these walled gardens, which would, of course, hurt TTD's margins and competitive moat. So for as intangible and maybe complicated as these privacy protocols seem, I know it doesn't make for very good podcasting to linger on them for too long, but the reason we're doing so, I think, is just to emphasize how important they are to understand. UID2 is the epitome of the open internet revolution and potentially the future of advertising outside of platforms controlled by companies like Amazon and Meta.
I think it's really not an easy topic to understand and to kind of wrap your head around. We even talked before the call and said that it's not even entirely clear how UID2 will be rolled out over the entire open internet and who actually has the biggest leverage when it comes to implementing it all over the place. So is it consumers who, have to either put down their email address or kind of accept their terms and conditions, pretty much like it is now with cookies? Or are we talking about the publishers, regulators, or the advertising agencies, since they ultimately decide where all the ad dollars go? I think all of this is still kind of in the open, and it will be interesting to see if they all can make it happen together. But now just keep everyone on the same page so we don't get lost in this rabbit hole of privacy and advertising tracking. Can you help us take a step back and maybe get to the investing case? So perhaps the bull case versus the bear case at a very high level for the trade desk.
I think it's a good call to take a moment here and take a step back, as you said. And for starters, as an unbiased advocate for advertiser budgets, TTD, again, has arguably a structural advantage over these less transparent ad giants like Google, Meta, and Amazon. And that is, in a nutshell, like a big part of the bull thesis. On top of just maybe generally believing that digital advertising growth will continue to outpace GDP, it'll become more and more effective, and will suck up dollars that are currently being spent on things like cable TV ads, especially as live sports content increasingly moves to streaming, since TTD has partnerships with both companies like Netflix and ESPN. And then I think you could get really excited about the proprietary algorithms and things like OpenPath and UID2 as almost perfect solutions for the needs of digital advertisers coming from the trade desk, especially for those advertisers that are interested in running ads programmatically across the open internet. So they are uniquely focused on what is in advertisers' best interests, which I do think gives them some type of competitive advantage. For as profitable as it has been for Alphabet to run a two-sided monopoly over digital advertising exchanges, that just is not sustainable because there are these conflicts of interest that are just ripe for exploitation that regulators were never going to tolerate indefinitely. And just lastly, if the firm can get widespread adoption of its solutions that simplify the advertising supply chain, it could, if you really buy into the bull thesis here, usher in this new golden age of programmatic advertising with the trade desk being at the center of all of it.
I've long been asking myself who even is still out there watching, legacy TV, as I sometimes call it. So I think it's more than realistic that we see way more ad dollars coming into this market in the years ahead. And probably the trade desk is the one company that will benefit the most just by looking at their market share data of connected TVs right now, which, as you said, is about half of the business. But now we've talked about the bull case. How about you tell us a bit about the bear case?
Well, the bear case is pretty straightforward, right? Most advertising dollars are routed to the ad giants. Firms like Google and Meta have a ton of power and really no incentive to work with TTD. And convincing publishers to adopt TTD's solutions like OpenPath will require considerable technological buy-in that is far from guaranteed to happen. The lack of industry adoption of UID2 would keep TTD's data aggregation and mapping costs high relatively, and just further disadvantaging them against these big tech giants. And on top of that, I should say that with connected TV advertising, about 75% of ad spend goes toward directly negotiated transactions. And only 25% of smart TV budgets go toward the type of programmatic advertising where TTD operates, meaning these big events that get live streamed on streaming platforms could go for directly negotiated ad deals that bypass middlemen like TTD. Point being, NFL games on a streaming platform are not guaranteed to be available to programmatic advertisers, even if it's occurring in a domain that the trade desk normally works in, if that makes sense. And on top of that, there's the risk that streaming players try to cut out Trade Desk more structurally. Amazon, for example, is using its own DSP for its ad tier subscriptions to Prime Video. So there is a risk that other large players like Netflix, Disney, and Spotify move away from what is beneficial temporarily to partner with TTD to eventually follow the Amazon playbook, where they try to take on the role of being an ad broker in their own advertising ecosystems, and basically the Netflixes and Disneys and Spotifys of the world essentially becoming walled gardens, to put it simply. And yet, the counter argument to that is that Amazon has been developing its ad platform for quite some time, many years, and has many partnerships already because of its e-commerce advertising offering, while these other streaming players just might find it a lot harder to develop their own ad tech stack and then actually build relationships with agencies and brands at scale to attract enough advertising dollars to make those investments in ad infrastructure potentially make sense, which is why, again, I think they kind of cop out to saying, let's just work with the Trade Desk.
That makes a lot of sense, but saying that 75% of the ad spend of connected TVs goes to self-negotiated ads, of course, that's not a good sign. And it's kind of, the counter argument to my bull argument I gave just 2 minutes ago, where I said there will be a lot of ad dollars coming into the market from all these, legacy TVs. But maybe to just linger on the bear case a bit further, one other thing I would mention are the recent shareholder lawsuits. I think in 2021, the board approved this massive comp package for CEO Jeff Green, which was actually one of the biggest pay packages in Silicon Valley history, from what I've heard. And even though the lawsuits were most recently dismissed, this still feels undesirable for long-term shareholders. Stock-based comp more than doubled as a percentage of sales because of it. And on top of that, there was another lawsuit just this year over the company potentially misleading investors about the potential of its new AI-powered system called Kokai, while they were actively having execution challenges while rolling it out. To what extent do these lawsuits give you pause?
I'm not going to defend it, but I'll maybe give a little more context on the pay package. So Green received about 19.2 million shares worth of stock options with an estimated value of, it's a lot, $828 million, something like that. But that money would only become exercisable in 8 tranches over a 10-year period, assuming the company meets certain goals for the stock price. So if it hits $90 per share, $150 per share, all the way up to $340 per share. And so he's actually had some chances to exercise these options, and he has held off on doing so. But yeah, if the stock ever reaches the high end of that range, $340 a share, Green could receive more than a $5 billion payout if he exercised those options. And that would be very dilutive. But also from a shareholder perspective, if we go to $340 a share, we're talking about a multi-bagger from current prices. So some dilution for the CEO is maybe not the end of the world at that point. And accounting for this pay package, though, and the value of the options has had a pretty outsized effect on the company's results, and almost alone explains much of the drop in operating margins of, they had 17% operating margins in 2020 to basically 10% or less over the next 3 years before finally rebounding last year. And that's really not what I expected when I first looked at this company. I was thinking, okay, this is, as we talked about, an asset-light platform. As it scales, as revenues go up, operating margins should go up. And really what I realized was that this big pay package is what has, I don't want to say artificially brought operating margins down, but it has distorted what is otherwise going on with the business. So there was definitely an upfront effect to what was meant to be this 10-year mega grant. And by the latter half of this decade, the incremental expense from that award will either be fully recognized or be much smaller relative to TTD's larger revenue base. So a smaller percentage of sales. And that makes it maybe a little more digestible. And honestly, we're not talking about Elon Musk here, who made headlines for what I think was one of the most egregious stock-based comp packages in corporate history, when shareholders approved this $45 billion package for him, just to basically incentivize him to continue focusing on Tesla with everything else he has going on. In my maybe naive impression is that Jeff Green is a very, very different type of person. Unlike Musk and many other CEOs, Jeff Green has signed the Giving Pledge. So he's giving away 90% of his wealth to charity. And actually, he's a pretty principled person. He exited the Mormon church because he believed that they were not doing enough globally to advance equality. So we're talking about someone who has been described by the Wall Street Journal as an aggressive philanthropist. And somehow, knowing that Green is this charitable person driven by more principled purposes in life makes me feel a little bit better about why he was awarded the pay package that he was, especially when you contrast that with these other big comp packages that CEOs have gotten, like with Elon Musk, as I said, where Tesla shareholders are almost literally bribing him for his attention. He does all these other things. And so you're paying him to massively prioritize Tesla. And I don't think that is what has happened here with Jeff Green. And of course, it bears mentioning, and I wish that the package was not as big as it was. So it's something of a yellow flag. But after looking into it more, for as bad as it looks on paper, I don't think it's quite as bad as it seems.
I think it's fair to say that the context here helps a bit. And I also rather see a founder CEO receiving such a package than, for example, an outsider CEO, just because they have the track record to back up what they did for the company. And still, as a shareholder, I would want what's best for the company today and not pay extra for past achievements. And a comp package that causes a 40% decline in margins just has a bitter aftertaste for me personally. But anyway, what can you tell us about the second point? And that was the drama surrounding Kokai.
Yeah. So let's start with what Kokai is. Kokai is a new platform from TTD to help advertisers maximize the effectiveness of their programmatic ad campaign. So it's an AI-driven optimization tool. And there's been a lot of excitement about it, as is true with anytime people mention AI today. But obviously, there's been some disappointment that triggered these lawsuits. People were hoping that it would dramatically improve the returns on ad spend that advertisers saw and help direct them on how to best use their ad dollars. This all came to light a few months ago when Trade Desk reported earnings for Q4 2024, and the stock pretty promptly fell 30% after the company missed its own estimate for the first time in over 8 years. So that is to say, for 33 quarters in a row, they delivered on or beat expectations. And so a lot of that had to do with Kokai beyond just the fact that they missed earnings. The rollout was slower than expected, and it kind of seems like advertisers haven't bought into it as quickly as anticipated. And I actually spent some time on a subreddit devoted to programmatic advertising. And while there wasn't a lot of love for Kokai, just to put it nicely, it sounds like they released the product way too early, rushed the timeline, and just shipped what was simply an unfinished product that they're now trying to fix. And that has damaged some relationships and trust in the industry. And I don't think the consequences are long-term, but they certainly could be. And still, rolling out a major AI platform is inherently complex, and a missed revenue target, while disappointing, doesn't automatically prove fraud. So we'll see how the case goes, but I'm not sure yet if this is more about TTD's management or just about AI more generally, and how there's now some pushback from investors and legal groups to force management teams across the world to kind of rein in expectations about what AI can actually do, which I think is totally fair. But I also wouldn't say Kokai is all hype either. According to the company, on average, clients have seen a 42% reduction in cost per unique reach, with 24% lower cost per conversion and 20% lower cost per acquisition. And so to any marketers out there, the numbers speak for themselves. They will know that that is really good stuff.
I think you don't even need to be a marketer to understand that those numbers look really good. And I would also be surprised if this actually turns out to be fraudulent in any way. And as you said, I think the expectations for AI are just becoming more and more unrealistic at this point. I mentioned this in our portfolio review just a couple of weeks ago, that investors as well as users expect AI to change everything and today. And I do think AI will change how we interact with many, many things, especially in the digital world. But turning to the old saying, people overestimate what they can do in a year and underestimate what they can do in 10. I guess the same is somewhat true for the expectations for AI, where people overestimate what AI can do in a year and perhaps underestimate what it can do in 10. So that might be what happened for Kokai as well.
Maybe I'll just read some comments from TTD's CEO in response to the disappointing Q4 results. So just reading his quotes here, he said, for Q4, the reality is that we stumbled due to a series of small execution missteps while simultaneously preparing for the future. If this were a sporting event, we would still have a championship caliber team, but in this particular game, we turned the ball over too many times. That said, we see a larger and faster growing market than we originally expected, which is why we have been making changes and will continue to do so. And so Jeff Green continues here by saying, first, we did the largest reorganization in company history in December. And while we often make structural changes at the end of the year to improve our business, this one was bigger than usual. For most people in the company, we provided a much clearer view of their roles and responsibilities. And for most, that also meant a change in reporting structure. So he rounds all of that out by saying, in Q4, there were a series of decisions that we could have made to enhance the short-term performance of the company and neglect the long-term. We consistently choose to focus on the long-term opportunity and maximize our market share over the long-term, as I believe that is in the best interest of all of our stakeholders. We are keeping our focus on the massive TAM and long-term opportunity.
You know what these sport metaphors remind me of? They kind of give me flashbacks to Nike's earnings report and what Elliot Hill said explaining the quarter. I think sport seems to just be a good way to explain hiccups in the own plan. But jokes aside, Trade Desk is not looking even remotely as bad as Nike's quarter. So I never cared much about a single quarter anyway. I think for them, it's more of a hiccup and it's definitely not thesis changing, at least from what I can see in the numbers. And in this case, I also buy into the story that they kind of rushed the process and that led to mistakes showing up in the product's performance. And if this isn't turning into a trend, which I don't think it did following the quarters after this one, I don't think there's too much to worry about.
The stock rebounded pretty dramatically after their subsequent Q1 2025 earnings report. And they did crush sales and earnings expectations. So that does make the Q4 stuff seem like kind of this one-off outlier. And some of the other highlights were that apparently 2/3 of their clients have now adopted Kokai, and OpenPath is continuing to drive some great outcomes. The New York Post, for example, reportedly saw its programmatic ad revenues double due to using OpenPath. So I see a lot to be excited about without dwelling too much on the initial Kokai rollout and the earnings miss and some of these negative headlines that I think could distract from the bigger picture here.
Yeah, it definitely sounds like they're now going into the right direction again. So maybe to transition a bit, Shawn, we can't have this conversation today without discussing the latest legal rulings against Alphabet more in depth, since this will probably very much ripple back to affect the Trade Desk as well, which is something that we've also been tracking because Alphabet is one, and I repeat myself, of our biggest portfolio companies. In fact, it is the biggest. So of course, our eyeballs are on that company specifically. And as just some context for the audience, on April 17, a US district judge found Google had engaged in anti-competitive acts to acquire and maintain monopoly power in the publisher ad server and ad exchange markets for display advertising, but stopped short of concluding that Google's ad buying tools hold monopoly power. But still, the opinion found that Google's advertising exchange, which is called AdX, was granted a first look at all requests for bids on inventory from Google Ad Manager services, which unfairly limited exchange competition. In other words, that basically just means in 2 of the 3 pillars of programmatic advertising as an ad exchange and in representing publishers, Google acted like a monopoly. But for supporting ad buyers, Google's actions are concerning but don't meet the monopoly threshold. So we don't know what will come next. yet, but the Department of Justice could force Google to divest from edX, which would allow for more competition in ad exchanges. And I would think more of a level playing field among ad exchanges should enhance the trade desk programmatic advertising business. But you would know that better than me, Shawn. So do you think that's what actually happens, or could it turn out another way?
I think you're onto something, and that is exactly what the thesis is here, that the programmatic advertising market will become fair in a way that it hasn't been for years, while revenues move away from Alphabet's Google Network segment toward companies like Trade Desk, Pubmatic, and Magnite. And it's pretty clear for publishers and advertisers to now see from the court rulings that Google has been something of a bad actor in the digital ad exchange space. And so that has fueled TTD's business to grow to 30% clip per year, while Alphabet's Google ad network revenue has actually been declining for 2 years after many, many years of steady growth. And basically, the court ruled that Google illegally monopolized 2 of 3 critical layers of the open web advertising market, the publisher ad server market and the ad exchange market. The DOJ now is seeking what they call structural remedies. And so they want to rectify the effects of these monopolies, the ill effects of these monopolies, I should say. So they have asked the court to compel Google to divest major parts of its ad tech business, including the AdX exchange, and then its DoubleClick for Publishers unit, which is now known as Google Ad Manager. And the idea would be to force Alphabet to sell off these units and dismantle Google's two-sided grip by separating the buy-side and sell-side operations into different companies. And again, this is where I should emphasize the beauty of the trade desk and being a neutral party devoted only to the buy-side of programmatic advertising. They just do not have the same entanglements that make everything so messy.
And do you think that will actually happen? I mean, we've seen cases and hearings basically on all the big tech giants in the US again and again. Nothing ever really happened, but in this case, it just feels like they cannot go back. Like now they have said that Google needs to split up these parts. So I think there's a high likelihood of it actually happening. Is that what you see as well?
Maybe it's a cop-out, but we don't know yet. I'm not an antitrust lawyer, but the status quo is clearly being rewritten in real time. And what I know for sure is that we won't return to a world where Alphabet can just continue to run both sides of the programmatic advertising market to the detriment of really everybody else involved, including advertisers and publishers. And Google has, of course, vowed to appeal any adverse ruling, and they're trying to argue that they face competition more broadly in digital advertising from Meta and Amazon, which just feels like such a classic example from Peter Thiel's book 0 to 1 on what to look for when companies have true market power. And before regulators, they try to redefine the area they compete in as being much bigger. So rather than specifically competing in programmatic advertising across websites where they clearly dominate, they try to zoom out and say they really compete in the world of all digital advertising, which is a much bigger market. And so they want to downplay their dominance. And that's actually how you kind of know it's a really dominant business. And unsurprisingly, the Trade Desk CEO, Jeff Green, has been vocally supportive of antitrust action against Alphabet. And he has even called for Google to exit the open web ad business entirely or be broken up by regulators. And his argument is that if Google's dominance has been due to vertical integration, and that forcing Google to quit at least one of those jobs, either on the buy side, sell side, or as an exchange, would remove these unfair advantages. And in his view, Google might choose to spin off the exchange part of its business, aka AdX, since it's less lucrative than its own ad sales on search and YouTube. And if that happens, advertisers would no longer be restricted to Google's exchange, and the Trade Desk could capture spending that might otherwise have been locked into Google's ecosystem.
I think it's not hard to see why Jeff Green is an advocate of that. But we've covered a lot now, from how programmatic advertising works to UID2, OpenPath, the shareholder lawsuits against the Trade Desk, and also the regulatory reinforcements against Google. So now comes the part where I ask you, how it all comes together to shape your view of TTD's valuation.
There is no way around it. Trade Desk is richly valued. The market knows they are a great business that is positioned to become an even better business, and that they have historically been operationally excellent. They have executed very, very well. And the founder, Jeff Green, quite literally was part of this small cohort of people who flipped the advertising world upside down and helped move ad deals away from being negotiated in person at fancy restaurants in New York to being a digitally native process where ad traders can bid on impressions across the open internet. He really made advertising digital. Back in the day, digital ad campaigns were exclusively negotiated directly by people. So there has been a real paradigm shift in that automation, and Trade Desk has been at the center of it. But yeah, point being, the market knows how great of a business this is, which is sort of unfortunate for us who would like to own it, I think, at 88 times last year's earnings and 40 times earnings estimates over the next 12 months. It's hard to look at this and say, oh, this is screamingly cheap without being at least very, very optimistic about their growth prospects.
So then I guess the question is, at what level do you find the stock interesting or attractively priced?
For me, that number is probably at around $50 per share or lower, which would require something like a 30% correction from current prices at the time of recording. And as part of that, in modeling the company, I did a lot of work to understand their margin potential, how profitable the business can be at scale, because I already know this business has a ton of room to keep growing sales as digital advertising increases and as new things like UID2 help make ad spend on the open internet competitive with the walled gardens. With the point being, I think the top line can easily compound at 15 to 20% a year for a while into the future. I don't have any hesitancy kind of estimating that, underwriting that. But given how much their operating margins have fluctuated, the key variable in my mind for understanding this company is how much operating leverage there actually is and where margins can plausibly be in 5 years. And just in the last 5 years, like I said, operating margins have fallen from 17% to 10%, then to 7%, back to 10%, and now back to 17%. So they've been all over the place. And before that, operating margins were actually more consistently in the 20% range. And so really, much of that has been distorted by Jeff Green's pay package that we talked about earlier. So when you normalize that and look at the margins the company's been able to achieve previously, while also accounting for the benefits of further scale for a software-driven business like this, I do not think it's totally crazy to think the business could hit a 25% operating margin a few years down the line. And so that expectation is sort of the basis for my valuation. If margins are half that, like the past few years, well, this company would just have dramatically less earnings power and value than I currently think is possible. And some analysts actually think they can hit 30% operating margins, but I find that to be a little bit too optimistic, given that the Google network segment at Alphabet doesn't even have margins that high, and they're running this two-sided monopoly. So it's hard to make an apples to apples comparison for TTD though, since many of its peers are much smaller or much bigger, like with Google. So it's hard to find good peer comps. Programmatic, for example, on the publisher side, has some pretty uninspiring operating margins, but they're also 1/70th of TTD's market cap. So they are not at the same scale either. And as we talked about, there's different economics between the buy side and the sell side. And the same with Magnite, which is also on the sell side working with publishers. And they're a company that only has 10% operating margins, but their market cap is also only $2.5 billion. So this is also not a huge business at its current scale. And on the other hand, AppLovin is a much bigger company than the Trade Desk, operating in kind of a somewhat similar area, but instead focused on advertising in mobile apps specifically. And their operating profit margins are actually well north of 40%. So that might make you think that 25% estimate for Trade Desk is too conservative at scale. So after thinking about the operating margins, looking at the range of comps for this company, thinking about what the company's done historically, estimating their margins by 2029, and then trying to assume what I think would be a reasonable exit multiple for a company of this quality with these kind of growth prospects, so maybe about 30 or 31 times operating profits, I think a reasonable fair price to target buying the stock at is between $45 and $50 per share. And given how far above that we are at current prices, I'm not recommending we add it to the portfolio.
I mean, a 25% margin assumption seems realistic without being overly conservative, I think. And AppLovin's margins are significantly higher, but that's also because the mobile ad market operates under a bit of a different model with much tighter vertical integration. And then you can add the scale to that. So I think that explains a lot of it. Now, could the trade desk eventually exceed 25% margins? Sure. But if 20% top line growth and a 25% margin only, quote unquote, imply a fair value of just below $50, then I think it makes sense to wait for the stock to come closer to that range, especially considering that I think for both of us, at least I assume that the underlying tech behind the trade desk remains at least somewhat of a black box. That doesn't disqualify it as part of a diversified portfolio, which we are building, but it does raise the bar in terms of valuation. And when you look at the stock chart, we've had several opportunities over the last few years to pick this stock up at $45 or less. That doesn't guarantee we'll see that price again, but just like with Amazon, volatility makes it much more likely that we eventually get a shot at picking it up. So what do you think, Shawn, to kind of put a close at it?
TTD is just a bit difficult for me to get comfortable with. I'll be fully honest. I was expecting for it to be easier for me to wrap my head around the trade desk after already having gone deep on Alphabet and Roku. But ad tech is just so very messy and complicated. I just feel like the ad tech industry probably goes in the too hard pile, and the trade desk, as a pure play on demand side programmatic advertising, you really need to understand the digital advertising ecosystem fully and technically kind of know what's going on behind the scenes to appreciate what makes the trade desk valuable and what can make it less competitive in the future. So this is one of those where having some industry experience would be very helpful. And you might be like, okay, well, how can you own Google or consider Roku since they're both also closely tied to digital advertising? And the difference is a few things. Firstly, Alphabet is a ridiculously diversified business that's dominating across a number of areas. So I don't feel like I have to be an expert on a specific area like cloud computing to appreciate the quality of what's going on there. And even with Roku, which I'm not as bullish on, but still, they're installed in tens of millions of homes and control how people access streaming content. And I've used Roku devices, so it's more tangible. I can understand the value of their positioning better without necessarily needing to deeply understand the relative technical advantages of their products and services. I know I've used a Roku and I know I've used an Amazon Fire TV, and I think the Roku is probably better, right? There's these kind of intuitive things. But with the trade desk, they operate as a pure play in a specific niche in B2B ad tech. And I don't work in B2B ad tech, obviously. So there's just no way, there's no B2C component to what they do, nor is there a lot of diversification to their business, for better or worse. So there's just no way for me to really know what's going on without having directly interacted with the services, without having worked in the industry, without having spent 100 hours talking to people who work in the industry. It's just one of those places where a lot of work is needed to be done to appreciate how deep or shallow their moats are.
When you and me were at the Berkshire's annual meeting this year, Buffett once said that Charlie always wanted to know and understand how and why things work. And Buffett was more or less okay with knowing, okay, they do work. And I found that very interesting because we always talk about, circles of competencies and all of that, truly understanding a business. But as investors, we don't need to understand everything if we can reasonably assess that something works. And we don't always need to understand the nitty-gritty details. However, that's where the margin of safety, at least for me, comes into play, so that when I'm aware that I don't fully understand everything, then I have to apply a higher margin of safety to the investment. And we did that for Roku, and we're doing it now for TTD. And that's why we decided to not add it at these prices. And with Google, as you said, the difference is that one, we got a price that we find very attractive, including our margin of safety assessment. And two, we both feel like we understand most of the company and its dynamics because we used it for decades. And I think that just helps a lot. And we cannot say that about TTD, and that just makes it so much more complex.
I feel like too much of an outside observer to ad tech, to say what is going to happen with OpenPath and UID2 and how that'll be adopted, or to try and predict, what Alphabet can do or won't do to protect their Google network sales from being lost to competitors. So the setup was been really interesting enough to catch my attention. But again, there are too many technical points, I think, that we need to understand. And maybe this is just me trying to be a bit pragmatic and honest about the difficulty of researching this one. But simultaneously, there's this weird thing where I feel pretty confident that if you said, hey, your life depends on guessing this right. Do you think Trade Desk will be a dramatically bigger or smaller business in 5 or 10 years from now? I would say I'm pretty sure it's going to be dramatically bigger, but that's just not how I want to make investment decisions. I think we want to be a little more thoughtful and more thorough about feeling like we know what really drives the business, and if not, at least having a very, very attractive price to entry to kind of hedge some of that uncertainty. So long story short, I am happy to pass on TTD and just watch it and learn more about it. But man, how funny would it be if the Trade Desk were to acquire Roku at a premium and then directly leverage Roku's wide reach to further cement their positioning in programmatic advertising? And so, I mean, a number of analysts have pitched the idea that the Trade Desk should acquire Roku, which is what drove me to want to learn more about the Trade Desk after having dug into Roku for a pitch 2 weeks ago. And we've run out of time to talk about it today, but Trade Desk has recently ventured outside of its core competency to launch a smart TV operating system, which would actually position them to more directly compete with Roku, but also would make sense for them to want to buy Roku and integrate them into it. So I don't know. It would be ironic for me to pitch these two companies, pass on both of them, and then to have some acquisition goes through that ends up at least being a big payday for one of them. So maybe we shouldn't get caught up in what ifs, Daniel. Why don't you give us your hints for your pitch next week?
Last time I pitched PayPal, and I kind of want to stay in the same space once more, just because I like the idea of researching more than just one business in an industry to get a better feeling for the competitive landscape. So this time, the company is significantly smaller and also a bit more niche, focusing more on peer-to-peer than PayPal probably does right now. And it did take a hit due to the newly proposed big, beautiful bill. And perhaps that's even too much already. So I think I'll keep it at that and let our community guess it.
All right, folks. Well, as always, we will leave you with a timely quote. This week's is from Henry Ford, who says, "Stopping advertising to save money is like stopping your watch to save time." The Trade Desk is very much tied to the reality that so long as the global economy is growing, so too will advertising, which is an essential part of business generally. And the Trade Desk is an essential partner for many digital advertisers. That is how I think about them at a high level. So that's it for now. Thank you all for tuning in. We will see you again next week.
People just expect their cards to work anywhere, instantly, and with no hiccups. I think the uptime for the Visa network is 99.999%. That's just huge. So it's not enough to be good. A network must be absolutely flawless, and Visa has been perfecting this for decades. And finally, Visa doesn't just offer technology, it's also huge on incentives. So just last year, Visa spent almost $14 billion on incentives. So when you add it all up, global reach, brand trust, reliable tech, and then those direct incentives, Visa just becomes an obvious partner, even for those bigger banks in the world that might have the resources to build their own network.